Good day, ladies and gentlemen, and welcome to the Steel and Tube Investor Update. Today's program is being recorded. At this time, I would like to hand the call over to Steel and Tube CEO, Mark Malpass. Please go ahead, sir.
Hi, good morning. Thank you for joining the call. Look, what I'd like to do, you'll all have seen the announcement that we sent out this morning at the market opening. I'd like to just touch on some of the highlights and then open up the call for any questions. And we've got Greg Smith here and myself, Mark Malpass. We'll be able to handle any questions following that. So, look, as I said, you'll have seen the announcement. We have updated our guidance for the end of this financial year and now expect normalised EBIT to be approximately $16 million, excluding one-off trading, non-trading costs and impairments of up to $54 million, which will result in an EBIT loss of $38 million. Now, this revised guidance does follow a company-wide review that we announced earlier this year and initiated of the entire business with the refreshed board and management team, and that had been previously advised. The review has resulted in the planned exit of our plastics business, further write-down of inventory values, a likely impairment of intangible assets, the rationalisation of some of our distribution and reinforcing operations, and completion of some further restructuring. So we, I guess on a trading number, the $16 million versus the $31 million for the prior year's EBIT, the bulk of that difference of approximately $15 million has been due to impacts associated with our ERP IT system. The market obviously remains fairly competitive, but as a result of these, earnings impacts, we expect to be in breach of one or more of our covenants on our senior debt facilities, and we are working with the banks on a waiver on this. I would say that the board and management are very confident that the change management program and restructuring that we have underway will result in positive improvements for the business in FY19. We are starting to see some recent improvements in volume trends coming out from the IT system change that we made earlier, and we're also seeing cost efficiency starting to come through from the restructuring initiatives that we've undertaken over the last 6 months. So those are the key points that I'd like to make. Again, the change program is well underway, and we are starting to make some good improvements with that. Any questions that I can take?
And ladies and gentlemen, if you would like to ask a question, please press *1 on your touch-tone telephone. Once again, that is *1 if you have a question. We'll pause for just a moment. We do have a question. It comes from Carolyn Holmes.
Oh, hi. I'm Carolyn Holmes from Share Clarity. Could you maybe just run through the issues with the ERP and the IT system and how it actually is? Is it just a one-off cost? Was there extra consulting type of costs? What actually is it? And if you were to exclude that, what's the underlying trading profitability looks like in the second half?
Okay. Thanks, Caroline. Look, I guess of that shortfall, the bulk of it is associated with volume impacts. So, when we first launched the system on the 2nd of October, we were having performance issues pretty much from the get-go, and that transpired to slow transactions, for example, over the counter at our distribution trade shops. It meant that manufacturing processes slowed down in some parts of our operations, for example, coil processing, where we're doing some quite complex manufacturing operations. So those processes were impacted. As we've worked through and improved the performance of the system with help from Microsoft AX and Sable 37, the software partner for the program, we've been able to resolve those largely resolve those system performance issues. And so, we're now back trading at the sort of speeds we would expect to. Also, the system change in terms of, just change management within the business. The organisation is now used to working with the system and being able to use it effectively. So I'd kind of look at that volume impact as more a custom loss rather than a customer loss. So, many of our customers, for example, in the roll forming business are now, we're trading not quite back to where we were, but getting close to that as we've seen some performance improvements coming back into the, into the system. The sales teams are able to get back on the horse and win back some of that volume that, was transferred on a short-term basis. So there have also been some costs associated with that sort of short-term impact. So these are costs, for example, extra temporary labour in areas like dispatch as we've dealt with some of the changes associated with the system. Now, some of those temporary labour costs are coming out quite quickly. So, these are what we see shorter-term impacts, although they will take some time to unwind in terms of getting that volume back into the business.
Yeah, that was probably going to be my next quick question in terms of just customers that you have potentially lost through this process. You said that the market is very competitive. How do you still feel comfortable that these customers understand exactly what's gone on and you haven't lost them?
Yeah, I mean, it's a good question, and we're working with all of our key customers and have done over the last 6 months as we've gone through the transition. Understandably, as some of the manufacturing sort of operations were impacted, customers are going to go elsewhere. But we have a very strong relationship with our customers, particularly in those impacted businesses in the roll forming and distribution steel businesses, where we've had deep and long relationships with many of those customers, and so a lot of this has been temporary. But there will be over-the-counter cash-type customers that will be difficult for us to win back, and we're working with them, and running programs to aggressively pursue any business that we've lost.
Okay. And just in terms of the bank covenants, could you maybe just run through some of the key covenants that you're in breach of?
Carolyn, Greg Smith here. Yeah,
Hi.
With the revised earnings today, obviously we end up in an EBIT loss position. So you can imagine that EBIT to interest cover ratio won't be met because of the one-off adjustments we're making to this year's results. That's the prime one, and we'll be working with the banks to go through a waiver process in the coming weeks. With the stock write-downs, there's a possibility of one other covenant temporarily being in jeopardy, but it's a marginal at this point, and again, that will be redressed before the end of the year. So, we're working with our banks, through that process.
Okay, so the key one is the interest cover. Are you able to indicate just what the covenant actually is? Is it 3 times cover or 2.5 times cover? Or?
The EBIT interest cover covenant requires us to maintain 2.25 times minimum cover. And clearly, when you go into a loss situation, you're not going to meet that covenant.
No. So I suppose as an analyst, we'd be looking into this in terms of just either an equity raising or something as a result of this?
No, not at this point in time. I mean, this is I guess some significant write-downs for us, but we're moving forward from this point, and the changes we're making and looking to drive underlying earnings back into the business at this point. We're not anticipating any equity raise is required or needed, and we expect to operate back within our covenant levels on a go-forward basis.
Okay, cool. Thanks ever so much. I'll let somebody else ask a question.
And once again, it is star 1 if you have a question. Up next is Chris Hutching.
G'day, I'm with the Stuff Group, and I guess you've covered a lot of things there that I was going to ask about. Can you please tell me what ERP stands for?
Hi, Chris. Mark. Look, the ERP is our Enterprise Resource Planning System, which is code for IT system. So it's our core backbone financial and operational system.
Sure. Now, your chairwoman has described this situation as largely legacy. Would that mean that investors would expect a return to profitability in the following period?
Yes, absolutely. Yeah, I mean, these are one-time non-trading impacts that we're taking here that are associated with legacy issues, you know.
Right. Okay. That's all I've got to ask. Thanks.
Thank you.
Our next question will come from Jenny Ruth.
Hi. Yes, I'm from MBR. You say that the non-trading costs and impairments are going to be up to 54 million, and you've got 12 million from exiting plastics. You've got 18 million write-downs discovered through the new ERP system, and a intangible assets impairment of up to 10 million. Where's the other 14 million?
Yeah, sure. Hi, Jenny. Look, so just to run through the high-level numbers, if you like, that might be helpful. The stock write-downs total about $23 million when you include the $5.5 million impairment that we took in the latter part of the first half of the financial year. So it's about 23 million, plastics impairment of about $12 million, other intangible asset likely impairments of around $10 million. We've also highlighted there some business changes within our reinforcing business of around a $2 million impact, some further restructuring of around $1.8 million, and then some other one-off costs of about a little over $4 million. So, between restructuring and other one-off costs, you've got another sort of $6.5 million there in those last two items.
The share price reaction suggests that investors have largely lost faith with this company.
We would certainly hope not. I mean, this is a company that has very good bones. There's some very good positions throughout the country. We have, as I mentioned before, re-strengthened and refreshed our board and executive team. We have some fantastic facilities and outstanding operational people throughout the business. We have very deep customer relationships. We've rebuilt our quality programs. We have some very deep, long-standing customer relationships that are continuing to build. We're seeing some green shoots coming through in terms of volume performance, as I mentioned earlier. We're seeing some costs starting to come dropping out of the business quite quickly. We're very confident between the board and management that this is a great business, that's a strong Kiwi company that's been in operation for over 60 years, and we see that continuing for another 60 years. This is a very solid business, I think. Obviously, a write-down of legacy issues of $54 million is a lot of money, and it's not something that we're very disappointed with as a team, but these are largely legacy issues that we're cleaning up. With any business that's been in operation for a long period of time, you can expect that there have been a number of issues with the past that, this is a new broom coming through and refreshing the business, and, you can expect that there are going to be some one-time impacts that we've crystallised as part of this announcement today, and we're moving forward from this point.
When you say it's legacy issues, I don't think I can remember the last time this company didn't disappoint. But I'm also struggling, what happened between November and May that all of a sudden you're discovering this? I mean, surely, I'm just wondering about the timing. Surely some of this must have been becoming evident before now.
No, absolutely not. I mean, we've been evaluating as part of our change program our go-forward, scenarios. These issues are, the ERP system, for example, has been something that we've been flagging for a while, has had some, clear issues. We flagged that earlier in the year. But as part of the ERP system now working as intended, we have been able to identify that there's some further stock write-downs required. The plastics decision is a decision that we only taken as part of a board review yesterday. And in fact, that decision wasn't taken until this morning. So I don't think there is any issue there.
And we'll take the next question. It comes from Carolyn Holmes.
Hi, just a couple of follow-up questions, if I may. More of a question to Greg. Could you split the abnormals and all the costs between cash and non-cash? And what is the tax effect of the abnormals?
Yeah, so largely the abnormals are non-cash when you take into account asset valuation write-downs. We have incurred some of those other one-off sort of costs. So those are cash in terms of the current year. I'm afraid I can't give you an update on the tax impact of that yet. We've only really just been finalising our earnings outlook in the last 24 hours. But mostly non-cash, to certainly the asset valuation adjustments.
Okay, so we're probably looking about the 6.5 or so being the cash component. The stock write-down comes out of your cost of goods sold, and the rest are obviously asset impairments. And presumably you'd get a tax break on the stock write-downs, and you get a tax break on the 6.5 million of cash items, maybe not the asset impairments as such.
That would be my expectation.
Okay, and then just on the S&T plastics business, you've said that you're looking at potentially selling the assets. So you've talked about the write-down, but also the carrying value. So what is the carrying value of those assets?
The current carrying value of those assets is somewhere between $12 to $14 million. We've anticipated that we may get something out of a disposal process. In fact, so more like $14 to $15 million, I should say. We hope to realise a bit more of that out of the sale process, but it's a little unknown at this point in time until we work through that with the market. Our preliminary investigation suggests that there could be some willing buyers out there, but the nature of the assets and the nature of that market at the moment makes that a little uncertain.
Yep, so we're only talking about a couple of million if you're able to sell those assets. Great. And what was the underlying revenue for that division?
Good question, Caroline. I don't actually have that information right in front of me.
But it's small in the scheme of things?
Yes, it's not significant to the wider Steel and Tube Group business.
Okay, all right. Thanks again.
And once again, everyone, it's star one to ask a question. Next up is Matt Henry.
Morning, guys. Just a few quick ones. On the inventory write-down, I guess $23 million seems like a huge amount of steel to me. And I guess intuitively, I think of your product as one that doesn't necessarily degrade. Can you just kind of explain to us, how you end up with sort of that level of inventory that gets written off?
Yeah, hi Matt, Greg Smith here. Look, a couple of things. We've done a detailed review of our inventory holdings, and given some of the, implementation issues we have experienced with the new AEX system, we've recently just completed a substantial stock take process across the business. Part of that, we took 5.5 as an aged inventory provision in the first half of the year, and based on the information we had at the time, we felt that was obviously the right position to take. As we've implemented and got better understanding through the AEX system, we have identified that there is more stock there that has been sitting around for some time, and as we've evaluated the realisable value of that, and the accounting rules require us to recognise that at the lower cost or net realisable value, there is a further impairment to some old inventory items. I think that's the reality of the outcome of recent stock takes and the detailed review.
Okay. And then just on S&T Plastics, can you just kind of explain what's changed there? I mean, looking back at recent results, the commentary has all been quite positive, and I haven't had much time to kind of go through stuff this morning, but just glancing at the last result, it says FT Plastics performing well. So I just want to know what's happened in 3 months that's gone from a business that's performing well to a business that's being closed.
Yeah, no, hi Matt, Mark Malpass. Good question. And the business had, I have to say the team in the plastics business have done an outstanding job of improving that business. We bought what was a business that was in receivership back in 2015 and have really got the plant up and operational well. We more recently last year completed the CPW, the Central Plains project with Downers, and that project did go very well. In fact, we reported against that earlier this year that we've been able to reduce wastage levels, which is key with plastics extrusion, down to very low levels. In fact, better than most industry norms. So the business had been performing well, but it is a very lumpy market. That irrigation market has effectively completely dried up. We've had the last sort of 3-4 months of just scraping around for on-farm work and things like that. It's just not a sustainable proposition going forward. We've done extensive work around market mapping as to what activity might be coming up, and we've just had to call time on this. That the reality is it's not a sustainable proposition going forward.
Okay, and then just lastly, you've talked about some restructuring that you've been doing. Can you just, I guess, talk through specifically, what you've been undertaking? So, I guess, understanding, the level of people, but also where in the organisation those people come from.
Sure. I think just at a high level, Matt, a couple of key things that we've done more recently in the early phases of our change program has been integrating the businesses that we acquired over the last 3 to 4 years that had been held separate, and those integrations have meant that things like facilities have come together. We've combined 4 facilities over the last few months where we've had duplicate facilities. Which we've also been able to simplify a lot of our operations. Things like freight movements we've been able to restructure. So all of those things do have one-time costs associated with them, and some of the impairments that we're taking here are around things like leases that we won't be able to sublease for a little while. So those costs come through to impact on the business in the short term. Close to 50 people have left the business over the last 6 months, and that has obviously some contractual obligations with a lot of those exits, but you don't see those typically pay out for 3 to 6 months. So those benefits will flow into 2019, but obviously we're lumbered with the costs in this financial year. So, there is a number of efficiencies that we've moved on that have unfortunate one-time costs associated with them, but will release earnings in FY19.
Okay, and is this all principally cost-driven? So is the motivation here principally about cost reduction, or you think there's actually some benefit around the service proposition as well?
Yeah, look, our actual change program is more centred right around the customer space. We have a number of initiatives underway that we've been, that are purely volume revenue, customer orientated, right from smaller opportunities in parts of our business chain and rigging, for example, through to core distribution improvements in our core businesses that will see improvements in revenue and a resetting of our go-to-market value proposition, strengthening trading stores and lots of other segments within our businesses. There is a supply chain improvement component to this, which is really about ensuring that we are providing the lowest cost products in the right locations throughout our network, which is some of the impairment around stock takes comes into that. And then lastly, there is a piece around procurement leverage, scale, using our scale far more effectively in the marketplace, and then the unfortunate impacts of people restructure and changes that we need to take as we become more efficient and capture some of the synergies and benefits associated with the acquisitions that we've bought over the last few years. So there's a real, there's 2 or 3 components to this that are really around revenue generation, cost out, efficiency improvements, and working capital improvements to our strategy going forward.
Okay, that's good. Thank you. I guess the concerning thing about the result is there's been a legacy of feedback from across the industry about deteriorating customer service from Steel & Tube for quite a long time, and then I guess compounding that with the ERP system issues of late. I guess we haven't seen any progress around that customer service, and until we get any sort of confidence around that, it's difficult to not sort of fear the worst looking forward.
Yeah, I guess we acknowledge some of that, Matt, and that's why we're driving these changes to move forward. We are seeing some, as I said, some improvements in our volumes in our core distribution business, which is over half our company. And, we believe we have turned the corner here, and, we really are on the front foot out there in the market with the new Steel & Tube driving the business forward.
Very good. Thank you.
Next up, we'll hear from Stephen Hudson.
Oh, hi, Greg. Hi, Mark. Just a couple of quick ones from me. Just on the EBIT interest covenant of 2.25, is that a headline EBIT number, or does the senior lenders allow any sort of normalisation at all to that numerator? Secondly, do you have a net debt to EBITDA covenant, and if so, can you give us what the 12-month trailing ratio is? And then just lastly, are you planning on any more material sale and leaseback transactions, sort of similar to the Stoneden site transaction last period?
Hi, Stephen. Greg Smith here. So, firstly, yeah, I'd love it if we had a normalised EBIT cover, but no, it is headline EBIT. That is the covenant that we have. So, obviously, that's the headline number that factors into that calculation. We don't have a covenant with the banks around net debt to EBITDA, but you'll note that we outlined our own capital structure policy around that, and we were targeting to be, less than 2.75 times. Clearly, with this result, we're going to be outside that, and so we won't be hitting our own targets this year end, but we'll expect to realign ourselves and move back in within that target range going forward. We have flagged when it comes to our property portfolio that Steel & Tube as a business is not really in the business of owning commercial property, but the reality is the vast majority of our sites are now leased, and we will continue to evaluate, whether holding the remaining properties or doing a sale and leaseback is the right thing to do. At this point in time, we have no firm commitments to do anything other than the current property that's on the market, but it is a continual review process.
Okay, so just assuming that there are no more sale and leasebacks, would you expect to come within that 2.75 times ratio sort of during FY19, Greg?
That is certainly our expectation, Steve.
Okay, thanks very much.
And everyone, at this time, there are no further questions.
Okay, any other questions out there? Okay, well, look, thank you. Excuse me?
No, there are no further questions, sir.
Okay, well, thank you all for participating, and I'm sure we'll be in touch. And thank you.
And once again, ladies and gentlemen, that does conclude today's conference. We would like to thank you all for your participation. You may now disconnect.